Just first off, defining mortgage insurance. It provides mortgage repayment default protection for the lender on individual loans. What that means is if someone has less than 20% down, this is protecting that other portion of risk that the lender is taking on. So the little house down here, you can see a good example. If you have a $100,000 house with 5% down, the $95,000 loan is the risk that the lender is taking on. Mortgage insurance paid by the buyer comes in to cover 30% of that loss, potential default, giving the lender's overhead only $66,500. So they're basically taking on 2/3 of the risk automatically. But whenever you introduce the MI, it adjusts the risk calculator that the underwriters are looking at, and they're determining, okay, this is a less risky loan because mortgage insurance is involved. Prior to mortgage insurance becoming kind of commonplace in the 30s, there was basically no one that could find home ownership unless you had 20, 25, 30% down. Banks just weren't willing to take on the risk without having some kind of default protection. This is probably pretty obvious to everyone here, but something I like to point out to buyers, sometimes they think it operates like any other insurance would operate, like it's going to cover your life insurance. If you died, the mortgage would somehow be covered or something like that, or hazard insurance. It's not going to protect you from your roof being damaged in a storm or anything. It's purely because you couldn't come up with enough money for a 20% down payment up front, you're protecting the lender's interest in default. So really it's you paying to be able to get the house, not that you're protecting yourself long-term into the future. There are some additional benefits. This is talking mostly about the power of MI allowing borrowers, especially first-time home buyers, the ability to purchase just because that risk offset. I wanted to mention on this slide as well, a lot of PMI companies have added benefits when you use them. The way that it works for us, because it's kind of our discretion who we use for mortgage insurance, we have like 8 different carriers that shop with us. We pull up pricing, looking at interest rates, points, all of the pricing, so to say. In that kind of book, we can also pull up a quote for all of the mortgage insurance companies for that individual credit profile. And they can, most of the time we're going based off of best price, but some of them out there, Enact is one of them. They have special features like, kind of like a home warranty almost. They'll cover certain, items in the house within the first year, just as, being a part of your policy with them. Now, most people, they don't really ever talk to their MI company, being that we usually pick it out based off of, the price scenario, what makes sense for them. They get an email from the mortgage insurance company. It reaches out and basically says, hey, thanks for choosing us for mortgage insurance. You can create an account. If you have questions, call the hotline, and here are the added benefits. I don't know a single buyer that I've worked with that ever reaches out to them. Go for it.
Is this the PMI, is that something you can negotiate down, or is it just like,
yeah, so depending on the profile, so credit score, down payment, number of borrowers, MI really looks at everything, even more than what we look at when we determine interest rates. They will give a percentage amount of default coverage that needs to be on there. Every lender's kind of, or I'm sorry, every mortgage insurance company is kind of competing with each other, so their numbers kind of change. Now, if you have a grade A 800 score buyer with 15% down, yeah, no kidding. I wish. Most of them already bought a house in the last 2 years. Those folks are going to have the best pricing from all the companies, so they all might be within like literally $1 or $2 of each other. Now, where you'll see some differences, some MI companies won't go over a certain debt to income ratio, so I just don't have them as an option if you're pushing your debt to income all the way to the top. The other ones might offer, MI at that range, but maybe it's a little pricier than you would otherwise see. So all that said, over the last few years, mortgage insurance has become so competitive for buyers that it's less than you've ever seen it before. Really well qualified buyers, even the ones that are putting only 3 or 5% down, they are still seeing maybe $30, $40, $50 for MI, and that's on $200,000 to $300,000 houses. So it's not the time where everyone thought, well, great, now I'm gonna have to pay $250 a month. It's rarely, if ever, going to be that expensive anymore. This is a little bit deeper about why MI is important. We kind of covered this already. Basically, it comes in as a middleman to allow borrowers access to conventional loans, whereas otherwise they would need to go FHA. I think this is a little bit of history on private mortgage insurance. FHA, introduced in 1934. I'm sure everyone here is very familiar with FHA. Specifically, I wanted to talk about FHA PMI. So if a borrower is going to go FHA and they're putting less than 10% down, they are going to have mortgage insurance for the life of the loan. If they hang on to that for 30 years, they will pay monthly MI for the entire time. If they're putting more than 10% down, they'll have MI, but it will fall off after the 10th year is complete. So year 11, it will go away. Nope, VA is no PMI on VA. Even if they have a funding fee, which is sometimes required unless they have a disability exemption, monthly MI is not a thing with VA. Yeah, that's why VA is awesome. I just to mention here, just while I have everyone, I've had some people, some agents reaching out to me. They have veterans that are getting set up with Divvy, and they're requiring them to put a down payment down, and they're requiring them to pay an exorbitant amount so that they can save up for a large down payment or closing costs down the road. VA is super friendly about credit scores, so nice about it. They require no down payment for qualified, so any veteran that's looking at their first purchase is going to qualify for this no money down program. They might even be on their second purchase and they could get a sizable amount of it taken care of or not needed as far as down payment. There's no MI. There is a funding fee. However, it's lumped into the loan and you just pay it down over time. If you ever sell the house, pay the loan off, the funding fee goes away. It's not like you net out at closing or anything. And if they have a disability, likely that funding fee is exempt. So that's kind of a, not about PMI at all, but something I wanted to note. I had a veteran the other day who called and was asking me about, potentially getting a mortgage. He was already approved through Divvy. I was like, if they're approving you, you're very likely going to be able to get approved through us as well. So a little bit more history on PMI. FHA was really kind of the first one to use it significantly. It was introduced back in the 1800s, which is kind of crazy, but it didn't really, affect the market in any grand way until FHA. We used it as a tool for first-time home buyers. You then have Fannie Mae. Once it was created, you have a little bit more of that coming into the conventional market. Talks about Freddie a little bit. Those are the two big banks, Fannie Mae, Freddie Mac at the federal level, who are buying up almost all the loans on the secondary market. One interesting thing here that I like to note talks about the Great Recession. After that, there was obviously a lot of pullback on home lending, just because the entire house lending market and the mortgage-backed security market blew up. So there was a point where no PMI companies were even in operation for like 3 years after 2010. That just was not an option. If someone was putting, less than 20% down, they either had to go non-conventional route or FHA, VA, government backed. So it's nice now that we, don't have to deal with those kind of archaic requirements, and people that are pretty well qualified can get the home that they want. This is a little bit more about calculating a payment. How do we come up with the numbers? I ran through it a little bit, but I like to note here just the rate. You'll see on the left side of the screen, about middle way down, rate 0.41. They're coming up with that coverage amount based off of the 30% coverage, 95 LTV, which is 5% down, and the 760 FICO score. Those are going to adjust a little bit depending on how aggressive the mortgage insurance company is against its other competitors. Once you derive those numbers, you can plug them into a calculation, and it pumps out a monthly payment. To be honest, I've never since my licensing school, I haven't done a long form paper calculation of one of these. It's all in the system. I plug it in, I pull the quote, and it pops out a number. So one thing that I did want to mention on this page as well, single premium. I think a lot of people don't realize this is out there, or they think it's so insanely expensive they'd never consider it. But with mortgage insurance, you don't only have to pay monthly. You can elect to pay upfront a one-time fee at closing to pay it off entirely and just make the mortgage insurance go away. Places where that is extremely effective. If I have a buyer who can qualify for Home Ready, Home Possible, that is a conventional first-time home buyer program. It will allow you to put 3% down. You have a reduced mortgage insurance premium, and you have reduced interest rate. Let's say someone qualifies for that and they can come up with 5% down. Most lenders, most situations would probably say, cool, conventional, 5% down, perfect. If they can qualify for this Home Ready program as well, we'll drop it down to 3% down, take the other 2% that they have left over, and we'll buy that MI out. Now they're doing 3% down with realistically, it's 5% down for them, but no mortgage insurance. If we did it the other way, they would have mortgage insurance still. And, as much as I've said good things about mortgage insurance, and it's a tool and it's a good thing that we need, anytime we can get a buyer to pay it off up front and never have to worry about it again, we're all going to look like winners. No. Yeah, it's just a tool. They wind up all around with lower interest rate, same down payment realistically, but their monthly payment will be less because of mortgage insurance being eliminated. So pretty cool. There's really also two sets of mortgage insurance purchasing. There's the buyer side, which is pretty much what everyone's aware of. And then there's actually lender paid. This is something I really never do, but it is something that's out there. If your buyers ever asked about it, it is basically in exchange for taking a slightly higher interest rate, or I don't think that they could pay more as far as like an origination fee or anything like that. That's why I don't really ever touch this. The only time I really think it would work is if they took a higher interest rate in exchange for a credit back, and then use that credit to pay off the mortgage insurance through the lender side. Basically, we're the ones who are reaching out to the MI company and saying, we'll buy it for them, thanks for your help, kind of thing. Not common though. this is another breakdown of when MI goes away, depending on conventional versus FHA. What's awesome is with conventional, it falls off automatically at 78% loan to value. What most people don't realize is that if they hit 80%, they can just call the mortgage servicer and request it goes off right then. So they don't have to wait for that 2% extra to come off. They can, call and request it to come off. Now, this is all entirely based off of the value at closing. We all know that the equity in your property is going up at the same, or it's probably accruing new equity faster because your house is going up in value over time. So you can always reach out to them, pay $500 and request that an appraisal be done on the property to get current market value. Let's say you do that. Even if you purchased 3, 4, or 5 years ago, you're not paying down the entire equity to 78 or 80%, but your house may have accrued value over time up to that point. If that does happen, you hit 80% just via a new updated appraisal, you can request them to take it off then as well.
Okay, so I'm just trying to understand.
Mhm.
I want a house, FHA, PMI, and then I have to put so much for it in that first.
Mhm.
At the end of the day, I have gone in and had it looked at it, and it was at that piece that, and I just stopped paying that amount, or was it?
Did you say it was FHA or conventional? So with FHA, in that scenario, what I would recommend is a rate and term refinance. So we'd refinance you over to conventional, eliminate PMI, and the rate and term basically means we're not going to give you any cash out equity, so your payment should stay the same or even go down a little bit. Mhm. Yeah, with FHA, if you put 3.5 or less than 10%, most people do 3.5. That mortgage insurance is going to be on there for the life of the loan. So once someone hits 80, even 75% LTV, if you're at 75% loan to value, you can have not great credit and probably still go conventional. So a lot of people are not pulling the trigger on a refinance to conventional to eliminate that mortgage insurance and give themselves a lower monthly payment because they think they can't qualify. But technically, you can go all the way down to 640 conventional, but you need the loan to value to be sizable, 75, 70%. Yeah. And then the more you put down with conventional, the sooner it falls off. So people putting 15% down, may only be paying mortgage insurance for 5 to 7 years rather than, with FHA where it would be on there for at least 11 years. So. Cancellation, this is just what I was talking about some more. Current value, that's the getting an updated appraisal. Some factors about mortgage insurance. Like I said earlier, they look at way more than just what we look at for determining interest rates. So everything from down payment, credit score, number of borrowers, occupancy type, property type, zip code, if they're self-employed, the debt to income ratio, low to moderate income designation, if they are affordable in an affordable lending program like Home Ready and Home Possible, that will give you a much lower MI, and if they had a previous bankruptcy or foreclosure on their credit report. So that's a lot. There's a lot going on there. But being that they are in the insurance field, it seems like they look at just about everything possible. So. All right, I think that's about it. Do you have any questions? Danielle? Debbie? No? All good? I appreciate you coming. This one is not the most exciting. I have a lunch and learn in 3 weeks if anyone wants to come. That one's going to be about fast track loan approvals. That is cross-country mortgages, fully underwritten pre-approval program. So let's say you send me someone, I get them pre-approved in the regular old standard way I do, where I run it through an automated underwriting system. I generate a pre-approval letter and I send it, I send it to them, and you guys start shopping. Let's say that they request to do this fast track program. I need them to sign off on a couple of disclosures, just allowing us to go to underwriting. But while you guys are out shopping, we will fully underwrite that loan for that purchase price, loan amount, and estimated taxes and insurance. Once we get it back from underwriting with conditions, a conditional approval, realistically, the only thing we need is maybe an updated pay stub in the appraisal, and we can close in as soon as 10 days. So I've seen files literally close, contract to close in 7 days with this program, just because we went through the fast track up front, got the underwriting all done. The house actually qualified for a property inspection waiver, which is an appraisal waiver. So we didn't need to do an appraisal. So no appraisal, all we had to do was send the file back to underwriting. They signed off and we scheduled the closing. It was awesome. Appraisal waivers. So if you have a property, they're going to need to put 20% down conventional. More down helps your odds of getting it, but we run it through an automated underwriting system. It's like a computer program that determines whether or not they're going to be able to get approved. It will also look at the zip code and the address that we plug in, because pretty much every lender that's going conventional has to run their files through that system. It's collecting all that data. So very likely the house 2 doors down was run through that. The house 3 doors down was run through that. It knows exactly what the values are in that area. If it can determine based on what we plugged in that it meets a more than likely valuation given the other comps in the area, it'll just say, don't even worry about the appraisal. You don't have to do it. So those are kind of rare. I don't see them all the time, but if someone's here's where you do see them. Yes. Yeah. And a lot of lenders will say, I can guarantee you we'll get one. No, you can't. There's no guarantee. You won't know until you plug it in, the address, the purchase price, the loan amount. You have to get all that in the system and then run it through that program. And then it tells you whether or not you got it. I've seen, people put 20% down and get an appraisal waiver. I've seen people put 40% down and not get an appraisal waiver. There's no perfect science to it. Yeah.
I didn't know why the next option didn't have that.
Yeah. Yeah. It's kind of confusing. To be honest, I don't ever tell buyers about it because I don't want them to be like, cool, Chris said I can get an appraisal waiver, because there's no guarantee. It's my favorite call to make after I run it through the system and I find out that we got one, because everybody's happy. The listing agent's happy. The buyer's agents are happy. The buyers are happy. I'm happy. It's just less steps, and no one has to stress out about whether or not it's going to come in at value. So cool. All right. Well, thanks for stopping by. I appreciate it. Have a good day, Danielle.
You too. Thank you.
Thanks.